I thought, well, I like that concept. There's smart money, there's dumb money. I often felt like I was dumb money. So I really was interested in this indicator. I implemented it, tested it out, and it was okay, but not great. But I really loved the concept. So I didn't let it go. I added some new information, smoothed it out, and all of a sudden it was pretty interesting. So I threw it into the mix. Again, didn't think it was anything special. But then in August, this was late 2014 when I stumbled upon it. And then in August of 2015, the market had sold off. All of my indicators were bearish except for this one relative sentiment indicator. And the market rallied 10% in a straight line. And I thought, oh, that's interesting. Fast forward another 6 months, market sold off 10% again. Everything was bearish in my indicator suite except for relative sentiment. Market took off and didn't look back. And I was like, darn, it's not cool being on the wrong side of that. So I went and I looked, and it turned out that anytime momentum was negative, but institutions were buying the dip, market tended to have their best annualized returns. So when I learned that, I just started focusing on relative sentiment. How does someone in their basement compete with that? And then lastly, and I think this could be the most significant advantage that they have, is that where do retail traders get their ideas? They tend to get their ideas from CNBC, Fox Business, Bloomberg, or institutional research reports. So you have the defense calling the offense's plays for it. And so if the defense knows what play the offense retail is going to run, they can front run that, take advantage of it. They probably already front run it when they're talking about it publicly. So you have all these structural advantages that institutions have. And if you can align yourself with how they're positioned relative to how the not so smart money is positioned, you might be able to participate in those better outcomes.